Okay, I want to go over some problems. My problems will be different from yours. Well, just to give you some practice on how to solve these problems. Now, interestingly enough, with managerial accounting, it has more to do with critical thinking and calculations as opposed to financial accounting where you have to consider debits and credits, the type of account, and things like that. Managerial accounting, and hence also cost accounting, because cost accounting is an extension, if you will, of managerial accounting. It's a more specific aspect of managerial accounting. Cost accounting, uh, along with its, let's say, older brother, if you will, managerial accounting, requires a different thought process than financial accounting, and you're going to see examples of that in these series of questions. We're not going to answer all 9 questions. We're going to go maybe like 6 or 7 of them, but enough so that you'll get an idea of what to expect and what's going to be required of you. Here we have some data, question 1, and it's going to have several parts. Several questions to this information here. Now, we see here that we have the unit price, sale price of $51. 300,000 units that have been produced in this 1 month period. The fixed cost cited, and so is variable cost too. So as you can already know, excuse me, it's important to divide your cost into fixed and variable, and sometimes even a combination thereof. We call it variable cost, semi-variable or mixed cost. But anyway, here are a series of questions, and the answers are here, but notice it says, what's the prime cost? Don't forget, prime cost is direct labor and direct material. Prime cost per unit, so the direct labor, 6, direct material, 11. 6 and 11 are 17. That's your prime cost, okay? The contribution margin per unit. Don't forget, contribution margin per unit, if you're going to do it on a per unit basis, is sale price per unit minus, excuse me, all your variable costs per unit. So, we know we have a sale price of $51, okay? We have direct labor, direct material, those variable costs, manufacturing overhead that's variable, the variable portion of it, and sales and general administrative expense of $4 of variable cost per unit. Add these 4 together, you get $31. 51 minus 31 is $20. 31 is variable cost, 51 is the sale price. Sale price minus variable cost, all variable costs. Not just manufacturing variable costs, but all variable costs. So that's why we have the SG&A there at $4. Gives you $31, which results in a $20 contribution margin per unit. Gross margin per unit. Now, gross margin, don't forget, is your sale price minus your manufacturing cost, and that is direct labor, direct material, fixed manufacturing overhead, and variable manufacturing overhead. Now, if you take, here we have the fixed manufacturing overhead of $1.8 million. If you divide that by 300,000 units, that means it is $6 per unit. So there's $6 per unit of fixed manufacturing overhead, plus the manufacturing overhead that's variable, which is $10, that's $16, plus the $17 of direct labor and direct material. So altogether, that's $33 there. 1.8 million divided by 300,000, plus another 6, plus 11, plus another 10, gives you $33. or 51 sale price minus your cost of goods sold, basically, gives you $18, which is the gross profit margin. See, don't forget, it is to get the gross profit gross margin, it is sales minus cost of goods sold. And cost of goods sold does not include any administrative or selling. It's only the manufacturing cost. Therefore, you got the 10 here, 11 there, 6 there, and the 6 there if you take 1.8 million divided by 300,000. Conversion cost. Don't forget, conversion is direct labor and the manufacturing overhead. Well, we know the manufacturing overhead for fixed is $6 because that's 1.8 million divided by 300,000 is 6 there. And we have 6 here for direct labor. So that's 12 and another 10, 22. It's the manufacturing overhead plus direct labor. Direct labor is 6. Variable is 10 variable manufacturing overhead, and this is 6. So 6, 6, and 10 is 22. So the conversion cost is $22 per unit. Variable cost per unit is, again, you take the variable cost. This is all your variable cost here, right? 6 plus 11 is 17. 17 plus 14 is 31. This is all your variable cost here per unit, so it's $31 per unit. Now, let me add something here. You know that on the 400,000 units, the prices are different. Again, we're dealing with 300,000 units, but we had to include all the manufacturing costs, which include the variable. The variable is going to actually go up. Okay, see this variable here is $10. Well, it would normally be, but with 400,000 units, that's an additional 100,000 units. And if you take this just to show you why there's a 1950 here instead of 18. We said the gross margin, the cost of goods sold was $33. Well, yeah, the fixed is there, but the fixed is over what? 400,000 units. In fact, let's work that out. I don't know how to work it out, boy, without showing you. Look at it this way. You have, how can I put this? Show you this. You have the, this is for 300,000 units, okay? So your variable cost per unit is going to remain the same, okay? Your fixed is going to, your fixed cost here, manufacturing overhead of $1.8 million. $1.8 million divided by that. That's 450, and then if you take $1.8 million and divide it by 400,000, you'll get $4.50. Okay, $4.50. That means that your cost of goods sold dropped by $1.50. The difference between $1.50 and $6 is $1.50. Therefore, your gross margin goes up by $1.50. You see that? Again, 1.8 million divided by 300,000 is $6. But if you divide it by 400,000, it's $4.50. It's $1.50 less. So if the cost of goods sold is less, that means the gross margin is higher by that same amount. Okay, that's the difference there. Okay. Let's go with what do we do? Oh, full absorption. Don't forget, full absorption is direct labor, direct material, and all the manufacturing overhead. Well, this is at 300,000. This is $6 plus the $10 here of manufacturing overhead is 16 plus the 17 here. 16 and 17 are 33. So full absorption cost per unit is $33. The variable cost per unit, again, is the it says the variable production cost. So notice that word production. So we do not include just $4 of variable cost for SG&A, sales and general and administrative expense. Okay, it's just a 6, 11, and 10, which is $27. Okay, and the full cost is everything. So it is the $9 here. In fact, if you add the 900 plus 900,000 plus the 1.8 million, that's 2.7 million divided by 300,000 gives you $9. Right? Add these two together and divide by 300,000, you get $9 per unit plus the 6 plus the 11, 10, and 4 gives you $40. That's full cost. Okay. Let's go to the next one. Let's see if I'm going to do the next one. But I'm not going to do all of them. Okay. Now notice this. Yeah, okay. This is not tricky. It's just you got to pay really close attention. Dayton manufactured 15,000 units last month, and these are the costs right there. Now they want us to calculate the variable cost and total fixed costs are expected to remain the same for the next month. But this time, instead of producing 15,000 units, they're going to produce 21,000 units. Now, where did this number here, total variable cost here? If you think the total variable cost, you think you're going to add all this up? Don't forget, folks, total variable cost goes up if you increase the number of units or goes down if you decrease it. So we went from 15,000 to 21,000 units. That's a 40% increase. How do you get 40%? There are two ways to do this. The way I have taught it is EV minus BV divided by BV. EV is the ending value, BV is the beginning value, and you divide again by the beginning value. So the ending value is 21,000 units minus the beginning units of 15,000. That gives you a difference of 6,000. And 6,000 divided by, again, the beginning is 40%, 0.40. Again, EV minus BV divided by BV. EV is the most current number. BV is the beginning value. EV minus BV divided by BV. 21,000 minus 15,000, which is 6,000, divided by 15,000. So we have a 40% increase. So these variable costs are going to go up by 40%. So if you add them all together, you get 3,464,000. All right, add all these up. Add these four numbers up. You'll get 3,464,000. Multiply that by 1.40. Unless you just want to go through multiply by 40%, then add them. But multiply by 1.4 and you get $4,849. $4,849,600. What's the fixed cost? Well, fixed cost does not go up in total. The total fixed cost will not change. whether you produce 15,000 units or 21,000 units. So just add these four up and you get that. So what's the total cost at 21,000 units? Add these two numbers up. The variable cost and the fixed cost is your total cost. And then divide that by 21,000 and you'll get this number here, the unit cost. Okay? Okay. All right, hey. Let's see. And of course, here it is down here too. I guess I need to show you this too. They simply multiply each one of them by 40%. It's the same as adding them all together and then multiply by 1.4. Okay? Either way is fine. You want to do it step by step or just do it in the aggregate, that's fine. And of course, this is your fixed cost. So total cost is the sum of this and that, which gives you this 6.395 million, and divide by 21,000 units. So again, you need to know how to calculate percentage difference. You call it percentage of change, and that formula EV minus BV divided by BV is universal. That is, whether you're talking about the percentage increase in the stock price, percentage increase in sales, a percentage decrease in, I don't know, wages, a percentage decrease in temperature. I don't care what you're talking about. If you're talking about the percentage of change, the formula EV minus BV divided by BV will always give you the percent of change. It could be negative or positive, whether you're talking about an increase or a decrease from the original. Okay, let's go with number 3. I don't know if we did. Let's see if I did. Number 3, again, this is interesting, and all you have to do, folks, this is very straightforward. You want to know what were the non-value added activities, and the book mentions it briefly. Here, for instance, variable cost A, and A is 2% of the cost was wasted due to poor direction. Well, 2% of this is $2,010. So out of 100,500, 98,490 was value added. Okay, you just simply subtract this from that and you get that number there. And the same thing here with B. 15% of this cost was time spent by limo drivers because of poor directions. Well, 15% of 108,500 is 16,275. You subtract that from 108,500, you get the 92,225. So what they're doing is they have to give you the percentage of what was wasted or non-value added, and you simply do the math here. This is very straightforward. Very straightforward. And it says what value would there be to the managers. This information, of course, lets you know what was wasted. You had $39,000, almost $40,000 of non-value activities, and that's a pretty big chunk. So, I mean, that could have been added to the bottom line. So, anyway, that's that. Let's see, number 4. Again, you need to construct 2 different income statements based on this information here. Notice this. This is the sales. What is this? Yeah. You got all your manufacturing costs, both variable and fixed. And then add them together and subtract it from the sales, you get the gross margin. Then you got your administrative costs. This is what you learned in 1810. Okay? Or at least the concept. Sales minus cost of goods sold. And cost of goods sold is the variable manufacturing overhead plus the fixed. As well as Um, again, that gives you the, if you add these 163, you get the variable there, and then you get to um, variable marketing and fixed marketing cost, okay? Whereas with the contribution margin, it is your variable cost and all your variable costs are lumped together, whether it's marketing or administrative, and then you have your contribution margin. Sales minus all your variable costs is contribution margin. Then you subtract your fixed. Now, the reason why I call it contribution margin is that once you get your sales, and hopefully your sale price will cover your variable costs, what you have left over is called contribution margin. You have this much money to contribute toward covering your fixed costs and hopefully giving you a profit. Okay, you have that. You have 155,500 that will contribute. Used to contribute toward paying your fixed cost and hopefully cover your profit. And notice the operating profit is the same. We just rearranged the classification. We classified the cost differently, but it comes to the same operating profit. Okay. Okay, let's see, number 5. Well, number 5 is the same as we did, I think, number 1. Okay, so we're not going to go over that. Again, it's straightforward. But I'll have you take a look at it here, of course. You can scroll through it, and you can freeze the frame if you need to and figure it out yourself. But we did the same thing pretty much in problem 1. And then these are the answers. And then, of course, this is how it was done. Okay? It's the details of how they solved the problems there, how they came up with the answers there. Okay? So you'll be able to check that, double check that. Okay? Number 6. Number 6 is really involved. It's a big problem. It takes a while to do. I mean, I do these problems myself too. Even though I have the answers, I do them before I look at the answers, so that I don't know. I need to try to stay sharp myself. So it's just a habit I have of, if I'm going to have you do it, then I will do it. But anyway, where was I? Oh, there won't be a problem this involved on the exam, but this is a very good problem because you have to do some critical thinking. You have to do some analytical thinking here. So I like this problem, and I may give something similar on the exam, but not as involved because of the time. But it's a good problem. And again, your how can I put it? Your examples will have different numbers, but it'll be the same concept here. Here we have a method of how this waste removal company charges by the pound based on all its cost up here. And this is a number of households and customers and business and how much waste they collect in tons. And now they want to change the way because they feel competition may undercut them at 4 cents per pound for business. So they restructured their pricing schedule to this right here in this paragraph here, where Evergreen CEO has approached the City Council with a new proposal. And you can read the details here. So what is the price per pound? So here you have this information, and right now, currently, the price per pound is 6.9 cents per pound. And the way you do that, I'll just walk you through this part. You add up all of this right here, 406,000, 1.3 million, 326,000. And the way I did it, I divided by the number of customers, which was add these two together, and you get 17,800 customers. And then you take that number and divide it by 2,000, because it's a ton. I mean, it's, oh, no, I'm sorry. You do not by the number of customers, by the number of the tons. 4.6 tons and 13.2 tons, and that's 17,800 tons. And you take all of this and divide that by 17,800 tons, and you get $114.72. And divide that by 2,000, which is a ton, and you get 0.05736. And you increase that by 20%, 1.2, and you get 0.06883 or 0.069. That's how I did it. Let's see how they did. Yeah, this is how they did it here. Well, the same way I did it. Yeah. How can I put it? They convert the tons to pounds before I did or after I did, but we come to the same number. I got 0.05736, which is the same as 0.0574 if you round it off to 4 decimal places, and then mark it up 20%. But then the second part, this is very involved, and here are the answers to the B portion. That is, on the new pricing schedule, what would the price per B? Price per B. Price would be. You notice that now the price for business would be 3 cents a ton, or 3 cents a pound rather, which undercuts the new competition that may come in, but they charge the household much more. I mean, almost 3 times as much. Now, how do they get these numbers here? Well, as you can see here under B, they got through a number of steps here. Okay? First of all, in terms of allocating, they're only going to allocate the administrative costs and truck cost based on the number of customers. This is the number of customers. This is the total cost here for household and businesses. And how they get that? Well, again, if you add the truck and the administrative, you get that divided by the number of customers is $102 per customer. Okay. Then they're going to allocate it the other cost, the third category, by pounds or the amount of waste collected, which is 4,600 and 13,200 tons, which is 17,800 tons. Divide that by the number of tons, you get that much per ton. And then you go and you split them up. Number of customers times 102 gives you that number there. And well, the rest you can read yourself. I mean, I won't sit here and read to you. But you see how they came up with this. Now, I'm not going to give you a problem this complicated because of time. But I will give you a problem. Let's see, at least I think it'll be equally as challenging. It just won't take as much time because your exams will be timed. You won't have, your homework problems and everything like this. There's no time limit. You can take your time. But in exams, the exams are timed. I typically give you the length of the time, the length of class time, and This is a course, a 4-hour class just about. If we are meeting online, I mean on ground, it would be from 10 o'clock to almost 2. So almost 4 hours. So you'll have 4 hours to do the exam. But once you start the exam, you got to finish it. I mean, in other words, I'll say it may be from 6 o'clock to 10 o'clock at night. Well, after 10 o'clock, anyway, we'll talk about that later. All right, where was I? Okay, number 7. Again, you need to prepare a cost of goods sold statement. But here, now notice this, folks. This takes, again, some straightforward analytical thinking. For instance, this is the information here. I'll just give you an example. Direct material at the beginning of the year was 22,100. It ended, the ending inventory was 25,400 from direct material. So let's look at direct material here. And of course you got, and this is the format for a cost of goods sold statement, okay? And you're going to have to construct one. So here our beginning inventory for material was 22,100. We know that during the year they use 45,500. So here we start with this 22,100. We use 45,500. Okay? And we end up with 25,400. So how do we get to that? How do we get to that? Is the question. Okay? Yeah. Well, if you start here, if you start with 22,000 and you end up with 25,400 and you use 45,000, that means if you add these two together, 45,500 and 25,400, you must have had available 70,900. Just think about that. Just think about that, folks. If I ended up with 25,400, they see the number there, and I used 45,500, I must have had available a total of the two, 70,900. So if I had 70,900 available and I started with 22,100, I must have purchased 48,800, because 48,800 plus the 22 I started with gives me 70,900. You have to back into it, plug in. We call it, it's like a plug. If you remember, in accounting 1810, where we had to do double declining. In the last year, double declining, you had to plug in a number to make it work. Anyway, I hope you see that. I'll say it one more time to make sure you get it. If we start out with 22,100 and we end up with 25,400 and we used 45,500, as they say here, that means we must have had available the total of the two, what we ended with, what we used. We must have had the combination of the two, the sum of the two, available. And if I start with 22,100 and I had available 70,900, I must have purchased 48,800. And that's just an example of how you need to work this out. Okay? And they give you the ending total here. So they have, they give you the 32,000. You start with the working process. You're going to end with this working process here. See, so you need to really have this listed here in this order. It will help you a great deal. So um, just to help you with that. Let's see here. I think everything else is pretty straightforward here. I think it's just, well, I think it's pretty straightforward. You have here also work in process inventory, 32,000 you began with. You end with 29,500. Okay. Finished goods at 53 and 73 there. Okay. So I think that's pretty much it, folks, for this one. Pretty straightforward. Okay. Let's see here, number 8. Oh, yeah, this is very simple here. The stores use a central accounting department. The cost accounting department last year incurred a cost of $172,000, and they're going to spread the cost between these two sites. Allocate the cost of $172,000 based on the number of computers sold. Well, 2728 plus 1672 gives you what, I think 3,400, and then 2728 divided by the total, that's the percentage, and you multiply that by 172. Okay, so what you got to do is add these two together and then divide each of them by that total. I'll give you a percentage and multiply that by 172,000, and it should come to the total here. Let's see, do they show you how to do it? Yeah. See? Now, where'd they get the 62%? If you take 4,400, so you take 2728 and divide it by 4,400, you get 6.62. You take 1672 and divide it by 4,400, you get 0.38. Well, 0.62 times 172,000 is this number, 106,640, and 0.38, because in your calculator you're going to convert to decimal. 0.38 times 172,000 gives you this. And you do the same thing with regard to sales revenue. That's just straightforward. And our last one here, let's see what that one's about. Yeah, and again, it's similar to what we did before. Direct material inventory. So I'm not going to go into detail with it, but notice what it says here. This is your direct material cost. This is at the beginning of the year. Costs incurred during the year was this, $5,100 in material. Direct labor costs, indirect manufacturing costs, which is overhead, and administrative and marketing. Okay, then you got your fixed portion here. Real notice it says on December 31, you had 5,100 pounds of material remaining. You produced 17,000 mugs. Prices were constant. That's your sales revenue. Finished goods inventory was $4,100. With that information, what is the direct material inventory cost at the end of the year? Okay, well, as you can see here, if you have, this is your direct material cost here, divided by the number of units you produce. So it's 30 cents per unit worth of material. And each mug uses 0.4 pounds, so it's 30 cents per mug. 0.4 pounds is 0.75 cents per pound. And you got that many pounds left at the end of the year. That's the total inventory. Again, straightforward here, but this is how they calculate the answers for you. And I'll let you take a look at that. What should be interesting to you is that now this lecture is probably what, maybe 40, 45 minutes. I don't know in a moment. It'll take about 2.5 hours basically to convert it to an MP4 because not everybody has an Apple. Then they'll upload it. It take another hour and a half or so because you upload to YouTube. You gotta upload it. That takes about 45 minutes, and it has to process it. I'm saying that to say that um, you know, I think I've gone over enough detail for you because otherwise I want to try to get this up before the night's over. Well, it's already 12:30 in the morning, but I gotta be up late. Anyway, that's too much information, right? Hope this helps, and we'll take it from there. Alrighty.